Houston retail market, first quarter 2026, and why smart investors are watching Houston closely. And Houston's real estate market continues to outperform expectations in 2026, and smart investors are paying attention. While national headlines continue discussing inflation concerns, consumer spending shifts, and broader economic uncertainty, Houston retail fundamentals remain extremely healthy. Strong population growth, expanding suburban rooftops, and limited retail supply continue creating favorable conditions for landlords, developers, and investors. In quarter one of 2026 alone, 627,000 square feet of net absorption happened, which is up significantly from 96,800 square foot during quarter one last year, 2025. That's the third straight quarter where demand has exceeded supply. Vacancy is also compressed about 5.7%, and average rents are hitting a record 21.19 per square foot triple net. Retail sales volume reached 488 million, and average sales pricing climbed to $310 per square foot. These numbers tell a very clear story. Houston retail remains one of the healthiest commercial real estate sectors in Texas. Population growth continues driving retail demand, and retail follows rooftops. But more importantly, retail also follows spending power. And Houston continues adding residents at a rapid pace, particularly in suburban growth corridors, where new rooftops also create demand for grocery anchored retail centers, restaurants, medical retail, fitness centers, service businesses, childcare centers, and professional offices. And areas like Katy, Fulshear, West Houston, and even Northwest Houston continue attracting families and businesses due to strong school systems, newer housing inventory, and higher household incomes. And that's why retailers continue aggressively expanding in these areas. Projects like Ellison Town Center demonstrate exactly where institutional capital sees long-term retail opportunity. Why retail vacancy remains tight. And Houston's retail vacancy rate sits at just 5.7%, which remains historically tight for a metro of Houston's size. And why is that, would you say? Well, because developers have become far more disciplined about delivering inventory. Following years of aggressive development cycles, many builders are now avoiding speculative overbuilding. Instead, what we're seeing is that they're focusing on pre-leased retail developments, mixed-use projects on high-income suburban growth corridors, but also for build-to-suit retail developments. And what this does is it creates a major advantage for existing retail property owners. Less new supply equals stronger pricing power. Record rental rates continue rising, and Houston average asking rents reached 21.19 per square foot triple net, and that's a record high. And meanwhile, premium urban retail in areas like downtown Houston and the Inner Loop are commanding nearly $31 per square foot. It's higher if you're right off of a major highway too. But why? Because tenants are competing for fewer high quality locations with strong traffic counts as well as demographics. And landlords with well-positioned retail assets are gaining leverage with tenants, that is. In West Houston, Katy and Fulshear are major winners. And this is where investors should pay close attention. Katy and Fulshear continue benefiting from population migration in higher income households, but also residential development and school growth and infrastructure expansion, all coupled with limited retail inventory. And as rooftops expand westward, retail demand has followed. So this creates opportunities for strip centers, for mixed use developments, for restaurant pads, for medical office retail, automotive retail, and service retail. And the Grand Parkway corridor remains one of the most attractive retail investment stories in Texas. So, consumer trends are changing retail strategy, and retailers are adapting to consumer frustration over credit card surcharges, also rising labor costs, higher operating expenses, and changing dining preferences. Despite some restaurant closures, major national brands continue entering Houston because of the long-term demographic story that remains strong. And this is particularly true in fast-growing suburban trade areas. What investors should watch moving forward? Investors should focus on population growth, household income trends for whatever area you're targeting, but also new housing permits and retail vacancy rates, and also traffic counts. But it's important for having good quality tenants and also future infrastructure expansion in the area. So the biggest winners won't chase overpriced assets. They'll identify future demand corridors before everyone else notices and start building. And that's exactly why many investors are aggressively targeting West Houston today. So I'll leave you with some final thoughts for the day. And Houston retail is not slowing down, it's evolving. And the investors who understand migration trends, consumer spending behavior, and development pipelines will likely outperform over the next several years. And if you're looking to buy, to sell, to lease, or to finance retail property in Houston, please visit houstonrealestatebrokerage.com and I can help you identify opportunities before they hit the broader market. And that, my friends, is it for the day. Please reach on out. I'd love to have a conversation with you. Take care.